Most people think they already know this story. Fast money, wild parties, a genius salesman flying too close to the sun. But here's the kicker, almost everything you remember? That's the fun part. The real scandal wasn't the yachts, not the drugs, not even the lies. It was the machine behind it all. A system where a stock could be worthless at noon and suddenly hot by 2 p.m. Not because the company changed, but because perception changed. And perception? That was the product being sold. Every confident phone call? A script. Every hot stock tip? Math designed to make someone else lose. Quietly, predictably, every single time. What made it creepier? It didn't look illegal. On the surface, it looked like Wall Street doing its thing. Investors thought they were buying opportunity. In reality, they were buying timing, and they were always late. This story isn't about one flashy broker or one wild decade. It's about how pressure, persuasion, and profit merged into a financial machine that turned belief into billions. And if you think this blueprint vanished with the 90s, think again. It's still here, only smarter, faster, and way harder to spot. If this story ended in the 90s, it would just be another wild Wall Street tale. But it didn't end, it evolved. The boiler room phones went silent, but the persuasion didn't disappear. It moved online. Now, cold calls are gone. Instead, it's viral posts, Discord hype, YouTube charts, and not financial advice. Disclaimers that somehow always sound like advice. The pitch is faster, the hype is louder, and the gap between rumor and real money, way too small. What used to take weeks of aggressive sales calls, now it can happen in a single afternoon. Thousands of retail investors pile into a stock or token because the momentum feels real. Here's the kicker. Most modern pump cycles don't look like scams at all. They look like trends. Clean graphics, confident predictions, screenshots of massive gains. It feels like opportunity, like insider access, like you finally showed up early. But the mechanics? They haven't changed. Someone still jumps in first, someone still controls the story, and someone still exits quietly while everyone else is celebrating paper profits. The tools are different, the speed is different, but the psychology? Identical. And that's exactly why the original blueprint still matters, right here, right now, long before the headlines, before the investigations. Before money started moving in 8-figure waves, Jordan Belfort was obsessed with one thing: selling. Not finance, not stocks, selling. As a teen, he wasn't cramming balance sheets. He was figuring out how to turn a simple product into a must-have. That's the real difference, because most people think financial fraud starts with bad numbers. It doesn't. It starts with masterful persuasion. Belfort didn't care what he was selling: seafood, door-to-door products, or later, stocks. He had already figured out the leverage point. People buy with emotion first and justify it with logic later. Once that clicks, things get dangerous. The product becomes flexible. The story becomes everything. By the time he stepped into brokerage sales, he wasn't a finance expert. He was a conversion specialist. While others studied market fundamentals, he was studying tone, pace, pressure, and confidence. He noticed the brokers making the most money weren't always the smartest. They were the most convincing. That insight flipped a switch. If persuasion drives the sale, accuracy becomes optional. And in the high-commission corners of Wall Street, optional accuracy quietly turns into profitable fiction. What started as ambition slowly became methodology. And that methodology? It was about to collide with a part of the market where storytelling wasn't just useful, it was basically unregulated. The timing couldn't have been better or more dangerous. When Jordan Belfort hit Wall Street in the late 80s, the vibe wasn't cautious, it was electric. Money was flying around, regulations were scrambling to catch up, and young brokers learned fast. Confidence often paid more than competence. Belfort landed at LF Rothschild, a legit firm. The suits were sharp, the commissions were real, and the pressure to close deals? Non-stop. This was an era where brokers didn't just sell stocks, they sold excitement. Phones never stopped ringing. Deals were measured by adrenaline. And for a natural salesman, it felt like the big leagues. Then came Black Monday, October 1987. The market didn't slide, it plummeted. Careers didn't bend, they snapped. Brokers who'd been printing money weeks earlier? Gone. Belfort was one of them. But here's the part most people miss. While others saw disaster, he saw a loophole. He realized the biggest money wasn't always in the biggest stocks. It was in places fewer people were watching, with fewer rules. That discovery didn't just redirect his career, it redirected his ethics. Moving away from polished Wall Street floors into the shadowy world of low-priced stocks, the game changed entirely. Companies were smaller, oversight was weaker, commissions were massive, and the line between aggressive selling and outright manipulation? Almost invisible. This is where the real engine of the scam kicks in: penny stocks. On the surface, they seem harmless. Cheap shares, tiny companies, low entry cost. For a new investor, it feels like a chance to get in early before the big players show up. But here's the catch: cheap doesn't mean good. Cheap often means unknown, unproven, or barely hanging on. Most penny stocks trade outside major exchanges, places like OTC markets, where rules are loose and liquidity is thin. And liquidity? It's everything. When only a few people are buying or selling, a small push can send the price soaring, at least temporarily. That's the loophole. If you already own the stock before that surge, your profits explode. And that's exactly what drew aggressive brokers in the late 80s and early 90s. Unlike blue-chip stocks, where commissions were tiny and watched closely, penny stocks offered crazy high commissions: 30%, 40%, even 50% per sale. Read that again: brokers could make more money selling the stock than the investor could realistically make holding it. The goal wasn't finding strong companies, it was finding sellable stories. In a low-info market, narrative drives price faster than fundamentals ever could. Once that clicked, penny stocks stopped being investments. They became inventory. Once penny stocks showed their potential, Jordan Belfort didn't just want to sell more, he wanted to control the entire sales machine. That's when Stratton Oakmont was born. The name sounded old money and prestigious, but behind the polished branding, something very different. This wasn't a glass tower brokerage. It started in a strip mall office that ran more like a high-pressure call center. The strategy was simple: don't hire experience, hire hunger. Bartenders, college dropouts, amateur hustlers, people who didn't know finance but could be trained to sell. Because at Stratton Oakmont, the product wasn't the stock, the product was persuasion at scale. New recruits were drilled on a tightly controlled script: hesitation, threat, questions, redirected, doubt, reframed as opportunity. The goal wasn't to inform, it was to close. Phones rang all day, energy stayed loud, momentum never stopped, confidence became contagious. New brokers watched top performers rake in massive commissions and quickly learned the unwritten rule: conviction matters more than accuracy. But here's the genius and the danger. This wasn't random chaos. The firm focused its entire sales force on specific low-priced stocks at the same time. That concentration created sudden demand. And in thinly traded penny stocks, sudden demand doesn't just move price, it creates the illusion of legitimacy. Investors watching from the outside saw the stock rising and assumed the market knew something they didn't. In reality, the market was one office, one script, and hundreds of phone calls repeating the same story. And once that illusion started working, the machine scaled fast. Now we get to the part that turned aggressive selling into a full-blown financial machine: the pump and dump. This wasn't sloppy fraud or random chaos. It was structured, repeatable, and built on simple math most investors never notice until it's too late. Inside Stratton Oakmont, it all started long before a single phone rang. The firm would quietly scoop up massive amounts of shares in a tiny, low-volume company, often just a few pennies per share. At this stage, the stock was invisible: no media coverage, no analysts, almost no public interest. Then came phase 2, the narrative. Brokers, trained by Jordan Belfort, didn't just say, "buy this stock." They sold a story: new tech, upcoming contracts, explosive growth, ground floor opportunity. Institutional money is about to move in. Accuracy didn't matter, urgency did, and urgency creates action. This is the exact moment the entire system becomes predictable. In a thin market, even small buying pressure could push the price way up fast. As hundreds of investors jumped in, the stock climbed, not because the company improved, but because demand was engineered. Once the chart started rising, it became part of the pitch, because visually, nothing sells confidence faster than an upward line. Brokers could say, "Look, it's already moving." Momentum replaced verification. Price replaced proof. This is the pump. Hype builds. Demand grows. The chart climbs. Confidence spreads. Then comes the part investors never see: the dump. Insiders who already owned huge positions quietly sell into all that demand. Every new investor's money becomes liquidity for someone else to exit. And in these thin markets, once demand fades, prices don't drift down, they crash. Suddenly, the SIX stock, down to 60 cents, sometimes in days. For many investors, this wasn't just a bad trade, it was college funds, retirement savings, or years of hard-earned money disappearing in weeks. Here's the uncomfortable math that made it all work. Insiders bought at pennies, sold at dollars. Investors bought at dollars, watched it plummet. The difference? The entire business model. No company success required, just the story lasting long enough. And the scariest part? No hacking. No illegal trading. Trades were real. Orders were real. Price movement was real. But the demand was engineered. The market wasn't discovering value, it was reacting to persuasion. Once that formula proved it could generate millions, it didn't just happen once. It ran again and again, each cycle faster, louder, and harder to detect. By now, you might think the whole operation worked because investors didn't understand the market. Wrong. The system worked because it was designed to bypass logic entirely. On the Stratton Oakmont floor, brokers weren't just memorizing scripts, they were studying how people decide. Every call hit psychological pressure points found in almost every high-stakes purchase. Step 1. Authority. Confident tone. Fast delivery. Zero hesitation. If someone sounds certain, your brain assumes they know something. Step 2. Scarcity. This opportunity won't stay open. Institutional buyers are stepping in. I can only allocate a limited number of shares. Scarcity triggers urgency. Urgency shuts down careful thinking. Step 3. Social proof. Subtle hints that others are buying, creating the fear of missing out. And finally, the closer the emotional pivot. Brokers stopped talking about the company and started talking about the investor's future, retirement, financial freedom, getting ahead. Once the conversation went personal, the decision became emotional, not logical. Here's the kicker. Most of these investors weren't reckless. They were cautious people trying to make smart moves. But when pressure, confidence, and opportunity collide in real time, hesitation starts to feel like risk. The goal wasn't to give investors full information. It was to give them just enough momentum. By the time doubt crept in, the trade was already placed. And in fast-moving markets, a few minutes of emotional pressure can outweigh weeks of rational research. As the money poured in, something else started changing. And this pattern shows up in almost every big financial fraud ever uncovered. When profits get easy, discipline is usually the first thing to disappear. In Jordan Belfort's world, success stopped being measured by performance. It started being measured by lifestyle. Office energy got louder. Risk-taking became normal. Excess became culture. Huge commission checks weren't shocking, they were expected. Celebration became routine. And when celebration becomes routine, perspective quietly slips away. Expensive suits, luxury cars, non-stop parties. Everything screamed success, which made the system feel legit. Here's the weird psychological twist. Visible wealth becomes proof of invisible legitimacy. New recruits walking in didn't see risk, they saw results. The environment itself was a recruiting tool. Years later, much of this chaos would be dramatized in The Wolf of Wall Street. But the truth? Behind the glamour, there was a warning. The growing excess wasn't just reckless, it was a signal. When a financial operation starts spending faster than it's explaining, something is never being explained. The louder the parties got, the quieter the fundamentals became. And while the outside world saw success, the internal structure was slowly becoming dependent on one thing that can't last forever: constant new money. Every system built on momentum eventually hits a wall: patterns. And patterns were where Stratton Oakmont's illusion began to crack. By the early 90s, regulators and market watchers started noticing something strange. Multiple small company stocks being pushed through the firm all showed the same weird behavior: sudden spikes, heavy volume bursts, sharp collapses, over and over. At first glance, these stocks seemed unrelated. Different industries, different press releases, different stories. But the price action told a different story. Markets rarely repeat patterns this precisely without a reason. Investors were noticing too. People who bought in at 5 or 7 watched their holdings crash to pennies within months. Complaints piled up. Some thought they just picked bad stocks. Others asked the uncomfortable question: Why do these stocks always spike right before they're recommended and tank right after everyone jumps in? This is where the math becomes impossible to ignore. In thin markets, organic price movement is messy and unpredictable. But coordinated buying creates structure, timing, fingerprints. Analysts started spotting large blocks of shares being sold exactly when public investors were buying. That timing? Not random. That's control. Once timing suggests control, regulators start digging. Behind the scenes, the SEC quietly ramped up attention. Investigations don't start with dramatic raids. They start with data, trading records, order flows, broker communications. Enough anomalies in one place and patterns turn into leads. Leads turn into cases. The firm's growth made things worse. The bigger the operation, the more it needed new investors to keep the system running. Small scams can hide. Big ones leave trails. And by the time the numbers lined up, the illusion of unstoppable growth was colliding with something far less emotional and far more dangerous: evidence. Once enough patterns turned into evidence, the investigation shifted from watching to strategy. And that's when things got quiet. Unlike the flashy scenes you see in movies, major fraud cases rarely start with lights and sirens. They start with patience. Behind the scenes, the SEC and the FBI began mapping every trade connected to Stratton Oakmont. Not just what stocks were sold, but when, and more importantly, who was selling before and after the spikes. In financial crime, timing often tells the story faster than testimony. Investigators dug into broker records, wire transfers, and internal communications. They compared client purchases against insider selling. Patterns emerged that were too consistent to be coincidence. Internal positions appeared before hype waves. Clients piled in. Prices peaked. Insider holdings disappeared. To the public, it looked like normal market swings. To investigators, it looked like coordination. Then came money movement. Large profits weren't just being earned. They were being routed through offshore accounts, shell companies, and structured transfers designed to hide the beneficiaries. In big scams, hiding the money becomes just as critical as making it. Inside Stratton Oakmont, pressure was mounting. Momentum had fueled growth, but investigations introduced uncertainty, and uncertainty destroys loyalty. Former employees began cooperating. Recorded conversations filled in gaps. Spreadsheets couldn't. Numbers show patterns. Voices show intent. And here's the flip. For years, the system relied on controlling conversations, guiding investors step by step. Now, those same conversations were being replayed in a different environment, where confidence no longer persuaded, it incriminated. At its core, the fall of operations like Stratton Oakmont wasn't just about investigations or legal pressure. It was about structure. Every pump-driven system carries the same hidden flaw. It only works as long as new buyers keep showing up. The moment that flow slows down, the entire model starts fighting something no hype can beat: market gravity. Think about the math. Insiders buy millions of shares for pennies. Then they push the story hard while selling those shares into rising demand. That means the system constantly needs fresh investors willing to buy at higher and higher prices. But markets don't grow forever. Eventually, the pool of new buyers runs out, and in thinly traded stocks, when demand fades, prices don't level off, they drop fast. This is the part most people miss. The collapse isn't bad luck, it's built into the design. Once insiders exit, there's nothing holding the price up. No strong earnings, no big institutional support, no real liquidity, just momentum that already burned out. And momentum, by definition, can't sustain itself. Scale made everything riskier. As operations got bigger, each new promotion needed larger waves of investor money to keep the illusion alive. Early cycles might need hundreds of buyers. Later cycles needed thousands. Each round had to grow faster than the last until growth itself became impossible. At the same time, pressure from regulators was tightening. Investigators began mapping trading flows back to leadership, including the sales structure built by Jordan Belfort. Agencies like the U.S. Securities and Exchange Commission and the Federal Bureau of Investigation weren't just looking at single trades anymore. They were connecting the entire system. And once structural weakness meets regulatory focus, collapse stops being a possibility. It becomes a timeline. Because here's the reality about financial manipulation. Hype can move prices, persuasion can move people, but math always wins. When the system finally broke, it didn't crash all at once. It unraveled in layers. Legal pressure built up. Insiders started flipping. The financial machine that once printed millions slowly ran out of exits. Eventually, Jordan Belfort was charged with securities fraud and money laundering, bringing one of the most aggressive pump-driven operations of its era to an official end. But here's where the story takes a turn that still makes people uneasy. The downfall didn't erase the narrative, it rebranded it. After serving time, Belfort came back, not as a broker but as a brand. Books dropped, interviews followed, speaking stages opened. And years later, his story exploded into pop culture through The Wolf of Wall Street. And that shift matters more than it seems. Because when financial crime turns into entertainment, the mechanics often get replaced by the lifestyle. The risk gets edited out, the consequences get compressed. The system behind it all fades into the background. Meanwhile, many of the investors who lost their savings never got a second act. No spotlight, no comeback tour, just account statements that never recovered. Here's the real irony. In modern markets, attention can be more valuable than credibility. The reason this story still matters isn't history, it's evolution. Because the system didn't disappear, it upgraded. The same persuasion machine that powered aggressive phone rooms in the 1990s now runs on algorithms, social media feeds, and viral content. Cold calls turned into short clips. Sales scripts turned into chart breakdowns. Boiler rooms turned into online communities. And the speed? It's not even close. Today, one trending post can move a low-volume asset in hours. One confident influencer can spark thousands of buy orders before most people even understand what they're buying. We've already seen versions of this play out, from meme stock waves like GameStop, driven by communities such as r Wall Street Bets, to fast-moving crypto cycles where momentum spreads faster than research. And once again, the pattern repeats. Early buyers ride the hype. Late buyers ride the drop. Because while the technology changed, the scale exploded. Markets still react to stories, investors still chase momentum, and hype still travels way faster than verification. The only real difference now is scale. What once required hundreds of brokers pushing phones all day can now happen from a single account with a large following. One viral moment can do what entire sales floors used to do. That's why regulators, including the US, Securities and Exchange Commission, continue tracking manipulation patterns across digital platforms and emerging markets. Because whether it's penny stocks decades ago or speculative digital assets today, the core risk hasn't changed. When excitement becomes the main reason a price is rising, fundamentals usually show up late, and by then, the momentum is already fading. So maybe the real question isn't whether one broker manipulated the system. It's whether the system itself quietly rewards manipulation when persuasion makes more money than truth. When Jordan Belfort built Stratton Oakmont, the strategy wasn't complicated, it was persuasive. The scripts were persuasive, the energy was persuasive, and the profits followed the persuasion. Because financial markets run on information, but information is almost never neutral. It's framed, it's packaged, and sometimes it's sold like a product. And when excitement starts looking like opportunity, momentum can feel a lot like proof. The story didn't end because persuasion disappeared. It ended because the math finally caught up. But that same tension still shows up today. Every fast breakout, every sudden surge, every once-in-a-lifetime play that somehow shows up every few months. Here's the uncomfortable reality. Markets don't just reward being right. Sometimes they reward being convincing. And in a world where narratives can move billions in minutes, one question still doesn't have a clean answer. How do investors tell the difference between real value and a perfectly engineered story?